So, if you look at the last 5.5 years since I took over, using that investment philosophy has led us to significant number of takeovers in the portfolios. In fact, we've had over 30, more like 34, I think, portfolio companies receiving a takeover offer in the last 5+ years. We've had quite a few in the last 18 months as well, which drove some of those strong returns I mentioned at the beginning of this webinar. So these are some case studies that I want to highlight. These are 3 stocks that we had very large positions in, and they all got taken over in the last sort of 12 to 18 months. And I want to highlight some of the attributes that they all share, which is really important and what we look for. So the first one is Silk Laser Clinics. Essentially, it's the second largest skincare clinic network in Australia. It's got about 120, 130 clinics. It's a founder-led business. So again, it's really important. The managing director owns about 8% of the company. It's in that sort of more defensive health and beauty category. So it's a bit more resilient in terms of discretionary spending. Had a very strong balance sheet. So we identified it at the end of 2022. Obviously, the market sentiment was very negative to the whole sector. But we looked at a company that was telling the market it was growing, strong balance sheet, was paying a dividend, generating really good cash flows, and it was forecasting 22 mil of EBITDA at the time. Again, it was put in that retail discretionary sector bucket back at the end of 2022, which created a really strong buying opportunity. It was trading at the time on an EV to EBITDA of 4.5 times. We bought in around $1.75, and maybe 4 or 5 months later, Wesfarmers bought it for $3.25. Another one is Symbio. So they're a leading T1 telco software provider in Australia. Again, a founder-led business. So the managing director and the board own a combined 22%. We really like that 75% of gross margins were recurring in nature, so quite sticky revenue base. At the time that we built our position, again, it was actually towards the end of 2022, beginning of 2023. It had a really strong balance sheet, $40 million of net cash. It was paying dividends. It was generating good cash flows. And even after it had a bit of a downgrade at the time, which is the reason why it got sold off, it was still on track to do 34 mil of EBITDA. Now, as I mentioned, that downgrade at the end of 2022 gave us an amazing buying opportunity. We bought the business on 3 times EV to EBITDA. 40% of the market cap was in net cash. We predicted that it's going to get acquired if it doesn't re-rate over time. And back in July last year, it got a takeover offer eventually after a bidding war from Aussie Broadband at $3.15, and we almost doubled our money there. And another good example is Pacific Smiles Group. So we took a position towards the end of last year around $1.06. The company got derated significantly by some large funds exiting the register, and it created a really strong buying opportunity to buy this business on 5 times EV/EBITDA. It's the second largest dental clinic network in Australia. It's a very defensive industry. It had a strong balance sheet, net cash positions, reinstated dividends, and it was very profitable. So again, these 3 examples give you a bit of a flavor that, if you identified some of those attributes that I talked about before, and you buy it cheap enough, it's either going to get re-rated or someone's going to buy it.